Hey guys, what is going on? Welcome back to the portfolio. As I do with every video, I want to start off by saying thank you to all the subscribers, all the viewers on the channel, showing the channel so much support. Definitely appreciate that, including all the great video content ideas that you guys have been posting on the videos. I definitely take a look at all of those, put those into a spreadsheet, a short list of videos that I hope to get out in the near term, including the video we'll be talking about today. There's a number of different topics I decided to condense down into one video. Each of these topics I've talked about on other videos, but I thought I'd talk about all of these as, again, these were suggestions for videos, as well as a lot of new investors on the market wanting to know a little bit more about the stock market as a whole. So I thought I'd take advantage talking about an update on the portfolio, as well as a few different topics that are very important, especially at the end of the year with taxes just around the corner. So you can see here the past 1 week of trading on the portfolio, emphasizing that very large downturn in the market. The worst week in the portfolio since I established this portfolio about 2.5 years ago, down 7.39%, 13,371.61. Each day of trading here, you can see the market has been dropping quite considerably, at least my portfolio. Let's take a look at VOO. This is a very good stock that gives a broad representation of the overall market. I just put out a video as this being one of the best buy and hold stocks that you can jump into, at least ETF wise, to jump into. You can see here a longer term perspective, 5 years. It's been doing very, very well, 49.71%. But if you take a look at the peak here, up 81%, or right under 81%. Before that, very large pullback here. 3 months down 17%, 1 month, 8.1%. Over the past 1 week of trading, down 6.77%. So we are definitely entering into at least what I believe to be a bear market. So let's talk the first topic here, a little bit about what drives the price of stocks. So essentially it's all about investor confidence. If an investor is confident about a particular company, or this could be a market segment or the market as a whole, they're willing to put more money into each individual stock. So if we take an individual company, for example, if there's a lot of optimism on a particular company, investors are willing to pay more money for that, and they will compete against each other and drive the price of the stock up. There's very heavy trading activity, but if a company loses confidence with investors, investors will try to sell that stock off, either to get out of the stock, to get out of that company, or to get out of the stock because the price is dropping, and then they'll buy it back later when it's cheaper, basically making money on that trade. So trading activity tends to decrease, and the stock market tends to start trailing off. And this can be applied to the overall market as well. As investors pull money out of the market, stocks will tend to decrease over all market segments. Yes, there may be some individual market segments that are still winners, or individual stocks, but overall the market will trend down because market money is pulled out, for example, because interest rates are increasing. It's more difficult, or at least it's more expensive to borrow money, so investors start paying back that money. Or other macroeconomic developments that make stocks risky. Investors will pull money out of the market, put those into safer vehicles like CDs, for example, wait for the stocks to trend down, and then start putting money back in when they think there is a bottom. Also talked about market timing on prior videos. It's very difficult, if not impossible, to do. Even the large institutional investors, high-frequency traders with all their computer algorithms are not able to predict those swings. So you as a retail investor definitely will not be able to predict that. But at some point, investors start putting money back into the market, confidence grows, and stocks start trending back up. And that's typically what a bear market is. So a bear market is when stocks trend down, typically over the longer term, and typically over 10%. If it's a short-lived downtrend and not quite as big as 10%, it's typically called a correction. And those can happen every year or so. A bear market every few years. And typically, bear markets are shorter than bull markets, and then you'll have a nice increase of the price of the stocks over the longer term, or at least that's the hope. And so, if you do get into a situation where, for example, VOO here, the stock is trending down, it's down 8.1%, you can take advantage of this by actually selling off the stock at a loss and offset some of your gains throughout the year. Again, I've talked about this on prior videos. Just a quick reminder here of some tax brackets. On the left there, you can see individual tax brackets, the income ranges in the middle, and then on the right there, you can see long-term capital gains. If you hold a stock for more than 1 year from the buying point to the selling point, you can reduce your tax liability. So if you buy a stock, sell it the next week, you're subject to the tax rates on the left. However, if you hold it for longer than 1 year, you're now subject to those tax rates on the right. So you can see a huge decrease there. These are updated a bit for the current tax year of 2018. On the left there, that 10% is the same, but the 15% has been reduced to 12, the 25 to 22, 28% to 24, the 33% to 32, the 35% stays the same, and the 39.2 has been reduced to 37. And in the middle there, the tax bracket ranges. We'll take a look at the long-term capital gains rates on the right, which are the same for this year. You can see that 0% goes up to 36.9. That is now up to 38.6. The 15% goes up to 406.750. That now goes up to 425.800. So a little bit of a tax advantage here this year with ordinary income. The long-term capital gains stay the same. But again, you can offset some of those losses or some of those gains, but with losses. So for example, let's say you made $10,000 this year trading stocks. One of your stocks on paper has decreased quite a bit. So for example, VOO here, let's take the last week of trading. Let's say you bought in at right around just to make the numbers easy, 240. It's currently trading at 220. You've lost $20 on paper. You really haven't lost anything until you sell off the stock. So even though you bought in around 240, the stock is trading for 220. You could sell it off for 220. If you don't sell it off, you really haven't lost any money. Yes, on paper, it looks like you've lost quite a bit. With my personal portfolio here down 7%, I really haven't lost any money until I sell those stocks off. Once I sell that stock off, then I have definitely lost money, $20 per share. Let's say I've made $10,000 on this stock. I sell off for a $5,000 loss. At the end of the year, instead of paying on taxes of $10,000, I only have to pay taxes on $5,000. So you can imagine if you're sitting in that 35% tax bracket, you can take 35% of $5,000 and essentially keep that. So you basically made a profit on that. So you can sell off at a loss and still make some money back. That example is a little bit exaggerated. I think you can only, for this upcoming year, decrease your or offset your gains by $3,000, but you can take the rest of that and hold it over for the next year. It gets quite complex. I don't really want to go into all the complexity in this video. This is simply an introduction to some of these topics. But again, I put out prior videos, individual topics about each of these on the channel in the past. So I hope that makes some sense to new investors on the channel. Again, what's driving the price of stocks, some of the terminology between bear market, correction, and bull market, and what a paper loss versus a realized loss is, and how you can use that at the end of the year to reduce your tax bill. So a lot of different topics here. I thought I'd condense all those down into one video here, as well as talking a little bit about my portfolio. Again, one of the worst weeks in the portfolio. And I think this is one of the worst weeks, if not worst week, of trading in the market since the financial crisis of 2008. So this is really a historic drop, one of the largest drops ever in the stock market over 1 week of trading. So I would not feel pessimistic necessarily if you are in stocks that have dropped quite considerably. There's a number of my positions that have dropped quite a bit, but until you sell off, you really haven't lost anything. You haven't really locked in any of those losses until that happens. So that's what I'm doing with the portfolio here, or at least that's what's been happening with my portfolio here over the past 1 week of trading. Let me know what you guys are doing. Have you guys lost quite a bit of money like I have on paper? I'm going to probably lock in some losses to offset gains here. So not to make the video too long, I'll kind of end it there. Again, if you guys enjoy the content on the channel, if you guys enjoy the video series, feel free to like, share, and subscribe. Let me know what you guys are doing with your portfolios. Are you going to be doing any tax loss harvesting? Are there any particular stocks that you think are cheap right now after the very large pullback? Or exactly what are you going to be doing? Holding cash, waiting for the market to continue to downtrend? Do you think this is a bear market or a correction? Any insights, please let me know. Always interested to see what you guys are doing with your portfolios as well. So I'll kind of end it there, and we'll see you guys next time.